Hey, this is Hutch with bankingtruths.com, and today we're going to talk about the biggest myth ever when it comes to designing a whole life policy for infinite banking. And having been at this for a decade and a half now, we know how the sausage is made when it comes to designing whole life policies. And we also know the shenanigans that other agents are up to. When you peel back the sheets of what these other agents are doing, you'll often find that there's some kind of career or captive contract issue where if they concentrate their business to this particular company, they get extra boosts, extra perks, extra benefits, extra retirement bonuses, deferred comp, whatever it is, for concentrating their business to this one particular company. And we don't play games like that. We like to be able to stay current and be able to pivot as the market moves. So we have broker contracts with all the companies and we get paid the same whether we sell this much or this much of said companies. It's probably not the most profitable tact, but it just makes our life easier because things change. Like there were the big regulation changes at the end of last year, and it gives us the freedom to go ahead and pivot without any conflicts of interest involved. So the biggest myth, what is it? The biggest myth, and it actually sounds pretty good, is that the best way to design a policy is always the lowest base premium to PUA ratio. Like you want to pay the lowest percentage into the base premium and the highest percentage into PUAs, which again, on the surface, who could even argue with that? That sounds amazing. But if I use this analogy, this chef analogy, that would be like saying this particular restaurant uses the best recipes, the best proportions of ingredients, and therefore it tastes the best. The meal tastes the best. But you also know that the quality of ingredients actually matter there. Like, does it really matter the proportions that the ingredients are mixed at if they are inferior ingredients? The answer is no. And so there's a mix. Like we always use the most term writer we can and therefore put in the most PUAs we can. But sometimes with certain companies, that requires a higher base. Or sometimes with certain companies, their best product isn't a life paid to 100 where you're going to have a low premium payment because you're stretching that payment out to age 100 and slapping on a term rider. Sometimes the best product is a 10 pay where you take 100 year to age 100 worth of premiums and compress it into the next 10 years. And so that base premium is going to be higher, but it's a more concentrated ingredient, if you will. It's more rich in nutrients, if you will, because of its structure. So it's not that cut and dry. And that's what we're going to spend the rest of this video looking at in terms of the best 10 pays, the best L100s, and compare it with the product and company out there, which is a good product and company where you can actually get the lowest base to PUA ratio, and you can see for yourself which one you like best. All right, so to back up my rhetoric with some math, I'm going to show you a company approved piece. And I'll let you know, we don't normally show these company approved pieces, but we actually came to our own conclusion by doing our own independent study in our 2022 Whole Life Product Update, the best IBC policies you can get. The video's there, but don't go there yet because we actually have some good context for you in the next few minutes, plus some examples at the end of this video. But I just wanted you to know that in showing this, we came to the exact same numbers. And Penn Mutual actually came out to be the most efficient in terms of both base policy and PUA ratios. And what you're looking at here is a life paid up to at age 100 policy for a 45-year-old. It's $1 million. Just paying premiums to age 100 against the other Mass Mutual, New York Life, Guardian, One America, all quality companies, their lowest base premium or policy. And what you can see is Penn actually has the lowest premium for that $1 million death benefit. And it also has the highest IRR for the death benefit, as well as the highest IRR, or internal rate of return, on the cash value for that time. Now keep in mind, there's nothing special happening here. There's no term rider. There's no additional PUAs. Dividends are just being rolled back into the policy as PUAs. But this is one of those kind of slow go whole life policies that get a bad rap out in the industry because they take whatever, 10 or 12 years or 14 years to break even, however long it takes. And what you can see is of that kind of base ingredient, Penn's has the most efficient. And why that's important is a PUA, a paid up addition, is essentially on the same chassis as the life paid up to 100. You're essentially just putting in a lifetime's worth of premiums in the first year. And if you did that outside, like not in a PUA, but you just bought a product like that, that would be a MEC, a modified endowment contract, and you lose your tax benefits right away. But the reason why you can do that inside of a PUA is because it's attached to a bigger policy. So they look at the whole kit and caboodle and decide that it doesn't MEC. And that's what we do for infinite banking, is we add a term rider so we can add a disproportionate amount of PUAs onto the base policy so that you can get in extra PUAs. Now, we also have a great video called Whole Life's Growth and its Riders, where we talk about what I just said conceptually with the analogy of a race car. And then we actually show a case study of different levels, like this kind of slow going policy, and then certain levels of PUAs and term riders on top of that, in case you're wondering. Not yet, though. So going back to the biggest myth that you'll hear from some whole life competitors is you have to have the lowest base policy to PUA ratios because PUAs are better, and it's true in that you can get more money in there sooner. But if the quality of those ingredients aren't as strong as you can get, say, with Penn Mutual, where they don't allow you to put as much term to base or PUAs to base, then does it really matter? Again, going back to the ingredients, you could have the best recipe in the world, but if your ingredients are lackluster, or they aren't organic, or they aren't grass-fed, or they aren't whatever the analogy that you like is, maybe it doesn't matter how efficient the recipe itself is. And that's what this chart shows me. Now, another thing to consider is in a whole life policy, death benefit is not a bad thing. The higher the death benefit is, the higher the cash value has to equal upon life expectancy, or it just kind of steepens the growth curve. And so the fact that Penn has the highest death benefit IRR, the lowest amount of premiums to the most amount of death benefit, also puts the most amount of lift, if you will, naturally on that guaranteed cash value, which is why you're seeing the cash value IRRs being so much stronger than most of the competitors. So some more evidence to dispel the fact that base premium is bad is to look at these 10-pay premiums, these contractually paid up in 10-year, 10-pay policies. It'll also give us a glimpse into what the company's PUAs look like, because remember, a PUA is just a lifetime's worth of premium paid up in 1 year. What we just looked at was something paid up in 55 years. This is paid up in 10 years. So it's a lot closer to how PUAs look. Not exactly, but remember, it's all along the same chassis. And so if we take a look, Penn again is number one. Their 10-pay premium isn't the lowest. It looks like New York Life is a little bit lower. But in terms of IRR, internal rate of return on both the death benefit and the cash value, they seem to be performing the best. And there's nothing else added to these 10-pays. We're just looking at the quality of ingredients, but we're front-loading 10 years of premiums. You can see Mass Mutual, you can pay a lot more. You can pay $71,000 for the same million of death benefit. And intuitively, you might be thinking, well, you're paying for less death benefits, so the cash value is going to just crush. Well, you can see it doesn't crush. It actually works out to be a close second in these time frames. And that's what we found in our own results, not just for a 45-year-old, but also for a 37-year-old and the 53-year-old, which again is in our 2022 Whole Life Update. Don't go there yet, because I got some other cool stuff to show you and tell you. But I want you to see that across the board, these 10-pays, just looking at base is bad. Well, you pay more premium for this base, but it's a richer ingredient. It's a more concentrated ingredient of goodness. So you could pay the lower base in the other one, right? And hopefully the thought is that enough term rider and PUAs will overcome that base premium, versus this 10-pay is just saying, what if we just front load the heck out of everything? And you can see that more base here would actually be good. Just, it's apples to oranges, but just comparing this to the life at 100. But again, going back to what I was trying to share, With the other example of the life paid up at 100, we're going to have a small layer of that and then some term riders and a lot of PUAs, which are going to act a lot closer to this 10 pay built on top of it. So all of a sudden, the ratio of how much base to PUA isn't as valid as, or isn't as important as how robust the ingredients are that you're putting into this blend. So continuing with the 10 pay theme, let's compare the leanest, meanest 10 pay out there, the MassMutual 10 pay, with the leanest and meanest L100 policy. And when I say leanest and meanest, I'm not talking in terms of performance, but in terms of being able to pay the least amount of base premium and the most amount of PUAs. And that would be Guardian. Both good companies, both good policies. And then we'll circle back and compare the Penn to each of them in just a moment. But just following along with the logic of, base is bad and you want the smallest number of base. If we look at the MassMutual 10 pay for a 50,000 premium, and this is on a 44-year-old male, preferred, the second best rating, the base premium is $11,780 out of a total premium of $50,000, making the PUA payments only $38,000. Versus with the Guardian, you can do as little as a $5,000 base and a $45,000 PUA payment. So 10%, or often referred to as a 1090, a 10% base, a 90% PUA payments. On paper, this sounds great. You're actually putting a lot more to PUAs, but again, it goes back to the quality of ingredients. And we know with the 10 pay policy, it's going to be a lot richer in nutrients, if you will, the Mass 10 pay than will the Guardian L100, because you're compressing a lifetime's worth of payment into the first 10 years. So some producers will harp on this 1090, this ratio of base premium to term ratio, like it really matters here, when in fact, when we look at the performance together, you're going to see otherwise. Now, to be fair, we tried to equalize the premiums as much as we could, but it's hard because you're dealing with different MEC testing parameters. And this is actually a little bit of an intangible benefit to adding more base. When you have a super thin base policy like the Guardian policy, you get cut off. You can't put as many premiums in. And you can see in the year 9 and 10, there's only $20,004 going into the Guardian. And in the Mass, and later when we see the Penn, we were able to fit in $20,236. So there's $232 twice in 2 years. So the Guardian has $644 less, which is kind of not fair to the Guardian, but it's not going to make that big of a difference when you see how vastly different the results are. And the other thing that's worth noting is that the Guardian policy actually becomes a MEC in year 26. Now, you don't have to MEC it. You could just stop paying in year 25, and therefore it wouldn't MEC. But you actually have the ability to keep paying in the Mass 10 pay here and later on in the Penn because they have bigger base policies. That actually is a benefit in that you actually have more capacity in the policy. And in the Penn, you'll see you can even stuff in even more cash than what we're showing here. But just using this as our baseline comparative analysis to do apples to apples, what you can see is by the 10th year, the MassMutual 10 pay already has an additional $9,000 in it. By year 15, it's got an additional $30,000 in it. By year 25, we just jumped to the end, it's got an additional $92,000 into it. The death benefit isn't quite as much on the Mass because of the actuarial structure of that particular 10 pay. But what you're going to see is the Penn actually has more cash value and more death benefit, and it has more capacity altogether. But just to dispel the myth that less base, more term is better, in this case, you can clearly see it isn't. And when we just go back to the breakdown, the Guardian is a 10% base, 90% PUA. With the Mass 10 pay, it's a 23% base, 76% PUA. And A lot of people also don't realize that you can add term riders and you can add PUAs to 10 pays. You can't fit quite as much as you can with an L100 chassis, but it still is possible. And that's why at the end of 10 years here, you can see the additional payments of $84.56 going into the 10 pay policy. They're not right for everybody. It does require kind of a bigger initial commitment when people need flexibility. Of course, once you really understand infinite banking and borrowing against the policy itself, it shouldn't really be an issue once you get a couple years worth into the policy, but it is something to note. So before we drill into the performance between the Penn and the Mass and the Penn and the Guardian, I want to highlight the qualitative differences between the Guardian 1090 and the Penn 16.5, 83.5, if you will. The Guardian is certainly a leaner ratio. 5,000 of base premium gets you 218,000 of whole life base death benefit. And notice with Penn, the minimum base we can do for this 44-year-old preferred male, we have to do 82.15 a premium instead of 5,000. It's an extra 64% of base premium. And some of you are saying, I don't want that because I heard it was bad. But if you remember from the early part of this video where we qualitatively compare and show the efficiency of the base premium, if the base premium of Penn gets you a better overall IRR, not only in cash value and death benefit, it's not necessarily a bad thing. And let me also remind you that essentially a paid up edition is the same chassis as you would have an L100 with the base premium. It just is front loaded with a lifetime's worth of premium in 1 year. So base premium really acts like a PUA. It's just more slower paid. But you want overall efficiency with it, and you see you get it with the Penn because you're paying an extra 64% over the 5,000 to equal the 8,200 of base premium, but you're getting more than 100%, almost 110% extra death benefit. And that just goes to the overall efficiency of what that base premium gets you. Death benefit, it gets you more death benefit for lower costs. But remember, the guaranteed cash value has to equal the death benefit by life expectancy. So it's going to give you a better overall growth chassis, growth trajectory for essentially the engine of your policy, if you will. So it's not necessarily a bad thing. And so, you know, you may be really wooed by this whole 1090 thing, but you might just be answering the wrong question correctly. Is it so much about the recipe or the ratio, or is it more about the quality of ingredients that go into the ratio to give you the best tasting meal, or in this case, the best performance? And that's what we're about to show you. So as we compare the Guardian 1090 to the Penn 16.5, 83.5, whatever you want to call it, you'll notice that the Guardian starts with more death benefit. And that's because of the low base. There needs to be additional term to be able to stuff in that much in PUAs. You'll also notice that death benefit stays flat for about 8 years. And that's because it takes 8 years for the 1 year term rider or to fully convert out, as you can see there. On the Penn side, however, remember it started with considerably more base death benefit. Half of that 911 was base and half was essentially term rider and PUAs. So you can see the term rider gets fully converted out by the end of by the 5th year, the PUAs start pushing the total death benefit up. That's because all the term riders gone. And that's what the actuaries at Penn told me is it didn't make sense for them to do anything more than call it a 50 blend of base and term because their base policy was so efficient. Having the extra term drag really took too long for the PUAs to convert it out. And it actually worked out to be more efficient this way. By year 10, you'll notice Penn has an additional 22,000 of cash value. It's almost 5% more cash value by year 10. Not to mention 220 some thousand or 230 some thousand of additional death benefit, even though it started with smaller death benefit. And again, that has to do with the efficiency of those PUAs and the overall efficient structure of the lean and mean, less premium and a more death benefit structure of their permanent life insurance product. At the end of the 25th year, you can see that Guardian has $1,051,000 of cash value and basically 6.7 of death benefit versus 1.2 million of cash value in Penn. Not quite, but almost there. So almost $150,000 more cash value and over $2 million of death benefits. So these are real numbers, especially considering you started this policy by putting in $50,000 a year. We're talking by the 25th year, almost 3 of those full premiums are just showing up as additional cash value, and there's an extra $330,000 of additional death benefit. And most people say they don't care about death benefit, but remember, if you're going to do this right, if you're going to do your retirement infinite banking style and you can get arbitrage off borrowing, then really you borrow against the cash value, and a lot of those loans you don't intend to pay back. The death benefit pays it back, and whatever's left goes to your heirs. So what's $330,000 amongst friends? It's probably kind of a big deal. Like, why wouldn't you want it? It allows you to spend more of your retirement since there actually is additional legacy value left behind. Let's take a look at guarantees. Now, when it comes to guarantees, you would think that something like a 1090 policy, $5,000 in base and $45,000 in PUAs, would beat something where $8,300 was going to base and the rest going to PUAs. But you can see that happens early on with the Guardian. It is winning in guaranteed cash value, which essentially just means no dividends are ever paid. But by year 6, the Penn starts to pull ahead in both the cash value and the death benefit column. Because remember, that term rider Guardian started with more death benefit, but once the term rider gets converted on the Penn, that is guaranteed because it's paid up additional guaranteed death benefit and the corresponding guaranteed cash value. No dividends are being paid here. Now, things are pretty close, but again, so much more money is allegedly going to PUAs early on. It's kind of crazy that the Penn is essentially winning from year 6 on, and even by the end of the study period, it's ahead by 21, not quite, over $20,000, 657 versus 678, and it's got an additional 110,000 of death benefit, which is pretty impressive. And don't get me wrong, all of these are quality companies making quality whole life products. So I worked at Guardian as my second company after a stint in Prudential. After Prudential had demutualized, that you could no longer get a piece of a rock there. They didn't sell mutual whole life anymore, but I serviced it. But Guardian, I still have some of my oldest Guardian policies. I later, when I first went independent, I got some kid policies from Mass Mutual, still have those. But most of my acquisitions throughout the 2010, that whole decade, were Penn Mutual Whole Life. And I had some of the same concerns that some of you have. Like, hey, these are bigger companies, Guardian and Mass Mutual, with slightly better comdexes in the high 90s versus the low to mid 90s. And so maybe I'm better off. Everybody says they're more solid and that Penn can't keep up with this great dividend. And they've been saying that for 10, 12, 15 years now. But when I stress tested the Penn, I wanted to see how bad it got before it actually was even with the Guardian and the Mass if you didn't even reduce the dividend. And that's what I'm about to show you now. Like, if we reduce Penn, how far can we reduce it and still have it be around even slightly winning, slightly beating the Guardian 1090 and the Mass Mutual 10 peg? Let's take a look. So in this scenario, we've lowered Penn's dividend by 50 basis points and kept Guardian's totally intact. It kind of goes along with the argument you sometimes hear from people selling it that Penn's dividend is too strong and they can't keep it that way. So if the second after you bought the policy, they dropped their dividend by 50 basis points, which is a massive reduction for them, and Guardian didn't have to, that would be the scenario. And what you can see is by the 7th year, the Penn cash value has pulled ahead, the death benefit's ahead by this point, and for the rest of the study period, it is steadily ahead. Now, if we look at 70 basis point drop, what you'll see is that again, the Penn is actually ahead this time by it takes till the 9th year. The 9th year it pulls ahead, so it takes a little bit longer, but then it is ahead steadily the whole time in both cash value and death benefit until the 25th year. The 25th year, the Guardian pulls ahead by $1,000 in that case. It's hard to imagine this scenario, but that's how drastic the stress testing has to be in order for that narrative to come true. So hopefully this video helped to dispel the myth that base is bad and that the less base you have, the better off you're going to be. It actually doesn't make sense because PUAs at the end of the day are really just an accelerated version of that base. So what's more important is the quality of ingredients that make up the recipe of your whole life insurance policy. Should you do the max term rider possible? Absolutely, but that's going to vary depending on what type of policy you get. And in both instances, we showed you that whether it be the mass 10 pay or the Penn Life paid up at age 100, both of them require more base and less term, but both of those base premiums were more robust and therefore got you better results. Again, none of these companies are bad. They're kind of like my kids. I love them all. I know they're good and bad qualities, but you have to do the testing and measuring to see which one is going to perform best for you. There's one more thing about base that you have to see. So again, with the bigger base of the Penn policy, say compared to the Guardian, if you remember the Guardian, you couldn't fund it past 26 years if you wanted to. And there may be a case. I know some of you may say, hey, 44 to 26, I may be in retirement, but maybe you don't have a retirement problem. Maybe you have these RMDs and force outs and you need a place to put them. Wouldn't it be great if you could at least put $8,400 and pump up your legacy value and borrow against that and manage your tax situation and take more from your whole life when the stock market's down simply by just pumping your RMDs into your whole life policy? Well, guess what? With the smaller base, after 26 years in this scenario, you can't. You're forced out. With the Penn and the bigger base, you can do it. Not only that, but instead of just 6 years of $50,000, that's all we could do in this particular scenario before both the Mass and the Guardian were cut off, and then you could only do 28 and then 20,000 and change. With the Penn, this is the absolute max you can put in. This is not what we illustrated. We did apples to apples. I think there was an extra $64, but other than that, apples to apples, instead of 6 premium payments of $50,000, how about 8? And then instead of $20,000 for year 9, how about 42 and then 23? So you can fit in an extra $77,000 in this instance than both the Guardian and the Mass simply by having that bigger base blend. So it's not always as cut and dry as it sounds with good rhetoric. Do the testing and measuring. Work with a company that will help you do the math for your particular situation to ensure that you get the best policy based on whatever your fact pattern is. Maybe you want to do a shorter pay. Maybe you want to do a longer pay. Maybe you need more flexibility. Whatever it is, we can help figure that out and help you test and measure what's going to work best for you long term. Hope this helps, and we'll talk to you soon.